Hey everyone, welcome back to the Web3 Daily Recap. Let's start with the markets. Not a lot of fireworks over the past 24 hours. Bitcoin's been hovering around 114K, tried to pop, but sellers smacked it back down. It's down about 1% on the day. Ethereum's doing worse, leaking from the 3,700 range and now sitting around 3,600, down nearly 3%. Zooming out to majors, BNB's floating around 755, down a bit. Solana looks heavy, another 3% drop. DOGE got hit even harder, down over 5%. The vibe feels cautious. A lot of people just don't want to touch risk right now. That said, we're seeing some subtle moves in the real-world assets sector. Looks like people are front-running upcoming regulation news. Also spotted some capital rotating into smaller Layer 2 names, possibly positioning ahead of an event, but nothing strong enough to build conviction. We're still in chop zone. Personally, I did nothing today. ETH was tempting after the dip, but I held back. Just doesn't feel like the moment. Right now, we're in a wait-and-see phase. Preserve capital, wait for the next real setup. So what actually caught fire across the entire crypto internet today? It wasn't a coin, it wasn't a hack, it was Justin Sun literally going to space. Like, no joke, not some rocket meme token. He physically launched into orbit on Blue Origin's New Shepard rocket on August 3rd. He's now officially the youngest Chinese astronaut in history. I saw his post where he said, "The universe is so big, I wanted to see it." My first reaction? Bro actually took Web3 to the stratosphere. Crypto Twitter went nuts. It wasn't just news, it became an all-out meme war. People made jokes about him increasing the velocity of exit liquidity and called it the first ever blockchain space mission. But the real viral moment? A comment under his floating in 0G video, Justin Sun didn't just moon a coin this time, he mooned himself. It blew up. And honestly, this guy's a marketing genius. He doesn't ride the narrative, he manufactures it. Youngest astronaut, Web3 founder, global flex master, the man's a one-man PR machine. His zero-gravity selfie? Probably the most viral Web3 image of the month. Did it pump any coins? Nah, but it shifted the vibe. In a boring market, that kind of wild energy is exactly what keeps people engaged. Love him or hate him, Justin's figured out the real alpha attention. I wouldn't be surprised if next month he says he's launching a Mars-based layer own. That's the level he's operating on now. And honestly, the way things are going, he might actually pull it off. The SEC just dropped a statement yesterday that could seriously shift the game. They said liquid staking services like Lido and Rocket Pool, not securities. Basically, they're no longer threatening these platforms with lawsuits for offering tokenized staking receipts. My first reaction? Damn, this is big. For over 2 years, this has been the gray zone everyone avoided. Coinbase got hit, Kraken had to shut down its staking product, and now? The same SEC is saying, if you're just staking for users and giving them receipts, we're cool with that. It's not just legal wording, it's a real signal, a reset. Since the new SEC chairman took office, we've seen a massive tone shift. They dropped lawsuits against Consensus, backed off from Uniswap, and now they're relaxing pressure on staking. It's like they're saying, we're done being the crypto cops, let's talk business now. This is a major unlock for Ethereum. There's over 67 billion staked on ETH, with Lido holding half that. Until now, people were scared to build around staking tokens like stETH, afraid it might be treated as a security. But with this move, the message is clear. As long as you're not selling promises or doing ICO-style shenanigans, you're good. LDO prices did bounce a bit after the news. Not huge, but you could feel the sigh of relief. This is less about short-term price action, and more about removing the shackles. Projects can now build freely, design liquidity layers, and not worry about a surprise subpoena. So yeah, this wasn't about which coin pumped today. It was about a legal mood swing that could shape the next cycle. And this one feels bullish. Let's talk about Tron's reverse merger, because this isn't just some random crypto project going public, it's a straight-up masterclass in political networking and old-school Wall Street ops. So here's the headline. Tron merged with a shell company called SRM Entertainment, rebranded it to Tron Inc., and boom, they're on NASDAQ. Sun's in as a strategic advisor. But if all you saw was the bell-ringing photo, you missed the whole movie. Dominari Securities handled the deal. Sounds familiar? That's because two new names just showed up on their board. Donald Trump Jr. and Eric Trump. Yeah, the Trump family. Coincidence? Maybe. But not really. Sun recently dropped $75 million into Trump's World Liberty coin. Tron is now also backing the US Dun stablecoin for Trump coin. That's not just close ties, that's active alignment. Some are calling it political lobbying, some say it's just smart business. But here's what matters. Despite having an open lawsuit with the SEC as recently as March, Sun somehow got this listing through. That takes power. Real behind-the-curtain kind of influence. The market? SRM stock, which was basically a penny stock, exploded. Went up 300% the first day, and 10x'd in 10 days. TRX saw a nice bump too. But the big story isn't price. It's the playbook. Sun showed the world how to take a crypto chain to Wall Street without going through an IPO, without a bank syndicate, just straight up merger and branding. And here's the wild part, this might be repeatable. In today's regulatory mood, as long as the business looks clean and you've got the paperwork and the connections, this route could become legit for other chains. So yeah, Sun didn't just launch himself into space, he just embedded himself in the deepest corridors of US finance. Here's the latest twist in the never-ending FTX saga. They want CZ to cough up $1.76 billion, claiming it was an improper transfer, and CZ just filed a motion telling the court flat out deny this nonsense. Here's the backstory. Back in 2021, when FTX was still king of the hill, they bought back the 20% equity they'd sold to Binance in 2019. Paid in BNB and FTT, total value about $1.76 billion. At the time, nobody raised an eyebrow. But fast forward, SBF goes full fraud, FTX implodes, and now the bankruptcy folks are coming for that money. Their argument? That buyback was done with stolen customer funds, while FTX was already insolvent. So Binance, by accepting it, benefited from a fraudulent transfer and should give it all back. CZ's response? Nah. His lawyers came in hot. First, they said the transaction was completely clean when it happened. Second, Binance isn't a US entity, so Delaware court? No jurisdiction. And third, and this is the punchline, you guys already admitted SBF was running a fraud circus. Don't try to rewrite the script and pin this on us. Basically, they're saying, you want someone to blame? Look in the mirror. Binance didn't cause the collapse your golden boy did, and he's doing 25 years for it. If the court agrees, this case dies here. No trial, no discovery. But if they push forward, it's going to be courtroom drama for months. Either way, it's a signaling moment. Does the system want to cleanly wrap FTX, or is this about pulling Binance back into the mud? This ain't just about the money, it's about who the system chooses to forgive and who they still want answers from. So the US just passed its first federal stablecoin law. At first glance, calm seas. But if you look deeper, there's real movement under the surface. The big shocker? It bans stablecoin issuers from paying interest. This isn't about tokens like USDC being illegal, it's about the people issuing them. You gotta be either a federally regulated bank or licensed at the state level. And even then, no interest. None. Zero. Now here's where things get spicy. Coinbase and PayPal, two of the biggest platforms pushing stablecoins, found a way to sidestep this. They're not giving interest. They're giving rewards. For example, Coinbase calls it a 4% APY reward funded by their own platform revenues, not from Circle, not from the reserves. Just a bonus. PayPal? Same move. It's all semantics, but legal semantics. And it works. When I saw this, I had to laugh. It's peak American finance. Regulators draw a red line and the industry just skates right next to it without crossing. But this isn't just legal acrobatics. It's a long-term setup. If the government decides rewards are just a rebranded yield, they might come after platforms next. Short-term, no real market move. But long-term, this changes the stablecoin game. First, they defined what a stablecoin issuer is. Next, they might regulate what platforms can do with those coins. But here's what really matters. The law passed, with bipartisan support. And the crypto CEOs, they were standing next to Trump at the signing. That photo op wasn't just for show. It means stablecoins now have a real seat at the table just in time for election season. You might not have heard of Creedy Finance. It's a brand new DeFi protocol on Sonic Chain focused on tokenized lending, launched barely a month ago, and bam, they got hacked for $4.5 million. Now normally, this would have been a GG devs gone situation, but plot twist, the hacker gave the money back. Here's what happened. On Monday, CreedyX noticed the exploit and shut everything down immediately. CertiK stepped in and traced. It turned out to be a multi-sig permission bug. Funds were bridged to Ethereum and spread across a few wallets. Sound familiar? Then it got weird. The team negotiated with the attacker, and it worked. The hacker agreed to return the funds in exchange for a bounty. CreedyX announced they'll reimburse all affected users within 48 hours. The hacker left behind a message saying, "This was just a test." This isn't a one-off. Last month, GMX got hit for $40 million. And the hacker there also agreed to a payout, $500K, to return the loot. This is becoming a pattern. Here's the thing, today's hackers aren't just smash and grab. They're starting to brand themselves as ethical exploiters. They go after unaudited, fresh protocols, expose a weakness, then negotiate a bounty. It's turning into an industry. From a builder's perspective, this is a double-edged sword. Sure, you might get your funds back, but at what cost? It sets a precedent. Attack first, talk later. Not exactly what you want to incentivize. In the first half of 2025, DeFi has already lost over $2.4 billion to hacks. Even if the number of incidents is down, the damage per attack is massive. Critics got lucky. But trust? That's harder to recover. Bottom line, bear markets make everything more fragile. Every dollar lost is a dent in community faith. Even if you plug the leak, people remember where the crack was. Galaxy Digital just made a big move. They're turning their NASDAQ-listed stock, GLXY, into a tokenized version on-chain. This isn't just some gimmick. It's a full-on compliance-backed asset, set to be tradable via whitelisted wallets on a blockchain. And we're not talking about synthetic tokens. This is the real deal equity, registered with the SEC, wrapped in a token, and issued by Superstate, the RWA platform built by Compound's founder, Robert Leshner. Superstate acts as the transfer agent. It's all above board. The moment I read this, I felt it. This is the bridge we've been waiting for. This isn't talking about bringing TradFi on-chain. This is literally putting NASDAQ equities directly into wallets. Galaxy's a heavyweight. Billion-dollar AUM, run by Mike Novogratz. They're not messing around. And now, they're pioneering a model that could unlock traditional stocks for blockchain-native users, no brokers, no gatekeepers, just a whitelisted wallet and access. And the timing couldn't be better. The new SEC chair, Atkins, is pushing Project Crypto, a plan to support tokenizing traditional financial instruments. His words, "We can't let the US fall behind in this migration." This is step one, and if Galaxy pulls it off, others will follow BlackRock, Fidelity, MicroStrategy, anyone who's got assets and wants to play in the new sandbox. Up till now, RWA has meant tokenizing bonds, real estate, cash flows. But this is equities. This could change everything. So yeah, Galaxy isn't just launching a new product, they're testing the plumbing of a new financial system. If it works, we're looking at global capital flows getting a lot more fluid. All right, that's it for today. Price-wise, nothing explosive, but under the hood, things are shifting. The US is clearly softening its stance. Liquid staking gets a pass, stablecoins get a framework, RWA is getting real. At the same time, guys like Justin Sun, love him or hate him, are still out here hijacking the narrative, injecting energy into a space that badly needs it. None of this is random. It's all about positioning. Who gets to write the story next cycle? Who gets to raise the money? Who gets to call the shots? If you're still here, still trading, still reading, stay sharp. Price lags behind narrative. Stories lead the market. You just have to spot the ones that stick. Catch you next time.